Okay, dear students, first of all, welcome to the second live revision class. As I mentioned in our very first class of SBR as well, live revision class. That first 2 to 3 classes, they will be very small classes. Time duration will be small and plus after simply let me make it simple. From class number 4 onwards, we will start the discussion of the past papers. And at least I would say 3 to 4 days before the discussion of the past paper question will be shared in the respective WhatsApp groups so that you people have enough time to attempt those questions, and we'll be discussing them in the live revision class as well. We will start from revision class number 4 onwards, and plus from revision class number 4 onwards, the time duration of the class will increase. Day will remain same, but the duration will increase. Okay. So it's a second live revision class. In the previous class, we have just discussed one IAS, that is IAS 16, property, plant and equipment. In today's class, let us cover more than one small IAS revision. And one more thing, please confirm that. I hope everyone is having these short notes of SBR. Yes or no, please reply. One student, there are two questions. Number one, if you have lost the notes, you can just ask in your WhatsApp group. Admin will reshare again. Okay, please just write in your WhatsApp group that admin please share short notes of SBR. They will share it with you immediately. Another question is that how many lectures should we see before the live revision class? I strongly believe that everyone is having a planner as well. Yes or no? Because admin people, they do share the planner with each and every students. So I hope every one of you is having a study planner. Can you reply on that? So simply students, you need to follow your study planner. So study planner will give you each and everything, that how many lectures you should be watching and everything. I hope it is clear now. So please, you need to follow your plan. Okay, students. So anything else you want to ask, or should we start, I think? Don't worry at all. When we'll start the discussion of past paper, so classes will become very interesting. Let us quickly do the revision of IAS 20. Accounting for government grants and disclosure of government assistance. In these short notes, of course, these are the live revision classes. Of course, you people are watching the pre-recorded lecture in which we have used the detailed notes. In detailed notes, each and everything is there. The main objective of these short notes is the main area of the IAS, at least you should obviously understand and plus memorize it. Grants should not be recognized until there is a reasonable assurance. Now, stop here. Number one, when we say reasonable assurance, IAS will not tell you what is the exactly meaning of reasonable assurance. It's just a professional judgment. Obviously, when your people, your organization people, they are meeting with the government representatives, within 1 or 2 meetings, automatically you will get to know either you people will be getting the government grant or not. So some of the students, they just get confused, sir, what do you mean by reasonable assurance? So IAS exactly will not tell you what is the probability of reasonable assurance and how you will judge it. It's just a simply, I would say, professional judgment. And let me give you the example of reasonable assurance. Like I have just announced that from class number 4 onwards, we will start the discussion of the past paper. So I think my announcement should have given you a reasonable assurance. Yes, we are going to do that. So that's just a simple example. So reasonable assurance is just your professional judgment. Until there is a reasonable assurance that grant will be received and conditions will be complied with. Now there are two types of grants. One is income nature grant, another is capital nature grant. Income grant given to subsidized expenditures should be matched to the related cost. For example, if your government has given you the grant for assuming, government's told you at the start of the business that this time government will be contributing around 40 or 30% of, let's say, salaries of your employees. So it means company will be paying 30%, 70%, and government will be paying 30%. So that sort of grant is an income grant. But that income grant relates to the cost, must match with the cost. Now, you need to know one thing. The grant which is income nature grant, another name is revenue nature grant. Now there are two possible accounting treatments. One, for example, your company has received the grant, bank or cash, let's say debit, or there's a possibility of government grant receivable. And let's say deferred income credit. At the year end, assuming when you are recognizing the salaries expense, the entire salaries expense is assuming $1 million. Okay. Now, the deferred income was, let's say, 3 lakh. Simply, you can debit the deferred income. And let's say other income. Obviously, in the P&L, there will be salary expense of 1 million and there will be other income of 3 lakh. Net impact will be your P&L will be debited by 700,000. But there is another possible, I would say, an acceptable accounting treatment is instead of doing this, or you can directly debit the salaries expense by 7 lakh. Deferred income 300,000. Cash or bank 1 million. Both accounting treatments are properly acceptable. No issue at all. Both are acceptable. Okay. Now come here. Grants for purchases of non-current assets. Can I say again, there are two possible accounting treatments. Grants for purchases of non-current assets should be recognized over the expected useful lives of the related assets. There are two acceptable accounting policies for this. Deduct the grant from the cost of the asset and depreciate the net cost, or treat the grant as deferred income and release the statement of P&L over the life of the asset. Deferred income and release to the statement. Simply In day one, you are recognizing a deferred income as a liability, then slowly and gradually we are amortizing the government grant, and that amortization is your income. The second acceptable treatment is treat the grant as deferred income. Deferred income means liability, and release to the statement of P&L over the life of the asset. Okay, now students, just I want comments from you. What do you think? Both of accounting treatments are acceptable. This is number one, okay? Both are acceptable. But what do you think? What is the problem, I would say, in the first method, where we are deducting the grant from the cost of the asset? For example, the property, plant, and equipment is assuming $100 million. There's a 50% government grant. If I deduct that, so obviously in my books, I'll be having a property, plant, and equipment of 50 million. Am I right? We will be depreciating this 50 million over the useful life of the asset. But just obviously this accounting treatment is acceptable, but please just try to understand the market value of actually asset is 100 million. Let's say you have just bought the plant for 100 million, but in your books, you are showing the same asset at 50 million. So obviously people can raise an argument that you just bought it for 100, why you are showing it at 50? So again, the answer is, if any organization who is not happy with this treatment, then you can go for another treatment. Another treatment is where you can take that government grant as a deferred income. Simply cash or bank will be debit and deferred income will be credited. Another thing you need to know, what is that? Yes. Financial statement will lack faithful representation due to this method. Agreed. Another thing, look at this. Grants should not be recognized until there's a reasonable assurance. Student, always remember one point. You will start applying IAS 20. When there's a reasonable assurance, you will be receiving the grant and conditions will be met. It does not mean that when you have received the grant, only then IAS 20 will apply. No. IAS 20 will apply when there's a reasonable assurance you are going to receive the government grant. It means you will be there's a possibility you are making a first entry of government grant receivable debit. The second entry is, let's say, deferred income credit. So I just want to make one point clear. It is not necessary that you will not start IAS 20 until unless you have received the grant. So IAS 20 is applicable when it is reasonable. There's a reasonable assurance you are going to get the government grant. It means government grant is IAS 20 is applied the day there's a reasonable assurance you will be getting a government grant and conditions will be met. Okay, now come here. IAS 23. Borrowing cost. Simply, borrowing costs are interest and other costs incurred when borrowing funds. Student, read it again. Borrowing costs are interest. We know that. What is interest? What is finance cost? And they are saying, and other costs incurred when borrowing what? Funds. Now, please try to understand. Let's say your company is a ABC company. Functional currency is the dollar. Let's say ABC company is a USA based company and all of their majority of their operations are in America. Majority of their transactions are in dollars. So simply they are dealing in dollars. Simply dollar is their base currency. Okay. Assuming they have taken the loan in euros. They have taken a loan in euros. can I say if they have taken the loan in euros, so obviously they have to pay interest in euros. Now try to understand. If they'll be making payment of interest in euros, now there is a possibility. There's a possibility. Then when they will be making the payment of interest, along with that interest, there's a possibility of exchange gain as well as exchange loss. Obviously, if there's an exchange loss, that will increase your borrowing cost. And if there's an exchange gain, it will reduce your borrowing cost. So if someone asks you the question that borrowing costs are interest, we know that. What do you mean by other costs? So I've just given you the example. If I've taken a loan in a foreign currency, then obviously I'll be making interest payment in a foreign currency. And there's a possibility when we'll be making interest payment in foreign currency, there's a possibility of exchange gain or loss. Now the question is, sir, how exchange gain or loss can arise in case of payment of interest in when we have taken a loan in a foreign currency? Please try to understand. Let's say I have recognized the accrued interest. Please, students, we have recognized the accrued interest, and let's say payment will be after the end of the year. Obviously, when actually I'm going to make the payment, exchange rate is going to be different. Due to different exchange rate, either there's going to be exchange gain or loss. But you just need to know one thing. The exchange gain or loss issue can only arise when we have taken loan in a foreign currency. In that case, whatever the exchange gain or loss comes, there will be a part of that borrowing cost. So borrowing costs are interest and other costs incurred when borrowing funds. Entities must capitalize. When we use the word capitalize, it means that becomes your asset. Repeat. When we use the word capitalize, it means that cost becomes your asset. Entities must capitalize borrowing costs that are directly attributable to the acquisition, construction, or production of assets that take a substantial amount of time to get ready for use. Basically, when we say IAS 23 borrowing cost, logically this IAS 23 borrowing cost is applicable on qualifying asset. Qualifying asset is an asset which actually takes substantial amount of time to get ready for use. Now, again, substantial amount of time. IAS will not tell you exactly how many months are substantial amount of time. IAS has given us the examples. Again, the professional judgment comes here. Assuming, let's say we have taken a loan to manufacture up to construct a building, let's say, to construct a building. And that building is, let's say, is a qualifying asset. So obviously it will take substantial amount of time. Another example could be, let's say we are manufacturing a power plant. To manufacture that power plant, we have taken a loan. So obviously, that power plant will take a substantial period of time to get ready for use. In fact, there are inventories. They do take substantial time to get ready. If you have taken loan for those inventories, under IAS 23, that is also treated as a qualifying asset. So simply qualifying asset is an asset which takes substantial time period to get ready for use. Again, IAS will not tell you exactly how many months. Again, professional judgment comes into play. But in IAS 23, you need to know two more things. When we say borrowing cost, actually there are two types of borrowings. One is specific borrowing. Another is general borrowing. When we say specific borrowing, for example, we have taken a loan. We have taken one loan for one asset, one qualifying asset. We exactly know for which asset, how much loan we have taken. That is specific borrowing. In case of a specific borrowing, how do we calculate actually borrowing cost capitalized? You will take the borrowing cost. Logically, from that borrowing cost, I will deduct a return on short-term investment. For example, if the borrowed fund was invested as well, so whatever return I have generated on that fund, that will be deducted from the borrowing cost. But you need to understand one thing, this net borrowing cost will be capitalized. For example, if it is 10 million, it is 3, then 7 will be capitalized. But you need to know one more thing. What is that? Let's say your company has taken a loan on 1st January 2025. This is the date when we have taken a loan. But qualifying, but expenditure on a qualifying asset, they started from March 25. So students, even though the loan was taken on 1st January 2025, but expenditure incurred on the qualifying asset was March 2025. So basically, borrowing costs from March 2025 onwards will be capitalized. The borrowing costs before March 2025 will be expense out. So for example, the asset qualifying asset was completed on December 2025. In this example, borrowing costs of last 9 months will be capitalized. Plus, if during the last 9 months in which we are capitalizing the borrowing cost, if during the last 9 months any amount which was deposited and on that amount any return we have generated, only that will be deducted. So let me repeat. For example, we started incurring the expenditure from March 2025 and qualifying asset was completed on December 25. Then in my example, only last 9 months borrowing costs will be capitalized. And if we have deposited any amount in the last 9 months, only the return on those funds will be deducted from the borrowing cost of last 9 months. First 3 months, borrowing cost will be expense out, that will go to P&L. And if we have invested the fund in the first 3 months, then return on that as that fund will also go to P&L. But this logic does not apply on journal borrowing. In case of journal borrowing, we did not borrow the fund for any specific qualifying asset, just a journal borrowing. It means there are number of borrowings which organization has already made, and from those number of borrowings, some of the fund is utilized for a qualifying asset. In case of journal borrowing, you need to calculate the rate of capitalization. Rate of capitalization. How do we calculate rate of capitalization? We have to take the interest and divide by simply the total loan amount. Into 100 will give you a percentage. Let's say you have calculated rate of capitalization. Now, how do we calculate borrowing cost capitalized? Simply borrowing cost capitalized is equal to expenditure incurred on qualifying asset into rate of capitalization. There's a possibility of n upon 12 as well. For example, expenditure was incurred on 31st March. And let's say asset was completed on December 2025. Loan was taken on 1st January 25. So in that case, I'll do 9 upon 12 will be capitalized. If second expenditure was incurred on, let's say, 30th June 25, I'll take the expenditure incurred, n upon 12. Now this n will be 6 by 12. But a very important concept is, in case of journal borrowing, how do we first we need to calculate rate of capitalization. After that, expenditure incurred, then into n upon 12. You will automatically calculate borrowing cost capitalized. In case of journal borrowing, there's no such thing of deducting the return on short-term investment. Deducting the return on short-term investment issue only arises in case of specific borrowing. IS 40 investment property. Definition: investment property is a property held to earn rentals or for capital appreciation. Let's say your company has bought a land, and they're waiting for some time. After that time, they will be selling that land. So simply, that is capital. It means you bought that property for capital appreciation. And there is one more, both. Normally, capital appreciation takes time. Let's say your company bought a building for capital appreciation, but it will take time. So right now, your company has given that bungalow on rent. So investment property means the property which is for rent, on rental, you're getting a rental income, or capital appreciation, or even both. But please always remember one point. In case of investment property, when we provide investment property on rent, then we do not provide investment property. We do not provide significant ancillary services. Now, what do you mean by significant ancillary services? Please try to understand. When we are providing a investment property on rent, we do not provide significant ancillary services. The question is again the same. What do you mean by significant ancillary services, and where do we provide such significant ancillary services? Please answer is hotel properties. Hotel properties. Students, we in hotel properties, we also generate rental income. But in case of hotel properties, when we are providing hotel properties on rent and we are getting a rent from our guest, in case of hotel properties, we provide significant ancillary services. Just imagine a hotel which gives room to the guest. So they are just not giving a room, they are giving significant ancillary services. There will be one proper lobby, there will be a proper receptionist, there will be a proper staff. They will take your luggage from lobby to your room. Even within the room, there will be significant services. If you need anything for eating, anything. So it means that in case of hotel properties, we do get rental income, but in hotel properties, we apply IS 16 property plan and equipment. Because under IS 16, why we are applying IS 16 on the rental income of hotel properties? Because we provide them significant ancillary services. But if I have given a bungalow on rent, so I will not be providing the same services which are available in hotels. So always remember one point. The rental income which is coming from hotel properties, we apply IS 16 because we are providing significant ancillary services. But in case of IS 40, when we provide properties on rent, we do not provide significant ancillary services. Investment properties initially recognized at cost. Student, one more thing. While answering your past papers, we'll be discussing, never make mistakes in basics. What do you mean by this? Like if you are writing something like investment properties initially recognized at cost, if instead of initially recognized at cost, you are writing at fair value, so that's a mistake. Do not make basic mistakes. Initially, investment properties recognized at cost. An entity can choose either. Later on, you have two options. Either go for the cost model or a fair value model. An entity can choose the cost model. Now listen, student, IS 40 investment property, you can choose cost model. But if you're choosing the cost model, then you have to depreciate as well. So always remember one point. If somebody asks you a question that do we depreciate investment properties, the answer is yes, we do depreciate investment properties if we follow the cost model. We do depreciate investment properties if we follow which model? Cost model. Okay. In case of fair value model, whatever the change comes in the fair value that directly goes to P&L, we do not depreciate the investment properties where we are using which model? Fair value model. And always remember one point. Students, investment properties, try to understand investment properties. Logically, investment properties should be kept at under fair value model. Why? Can I say, if you have made an investment, let's say, obviously you will always be interested to know what is the fair value of your investment today. Actually, nobody is interested to know how much did you pay to buy that investment. In case of investment, obviously everyone is interested to know what is the fair value of the investment property today. So it is more, even though both the models are available, but it is more logical in case of investment properties to follow fair value model rather than the cost model. The fair value model recognizes investment properties in the statement of financial position at fair value. Gains and losses on the remeasurement are recognized in the statement of P&L. And plus, always remember, under fair value model, investment property IS 40 fair value model, no depreciation. Simply the changes in the fair value, they directly go to P&L, profit and loss. IS 38, intangible asset. Definition. An intangible asset is an identifiable, non-monetary, without physical substance. When we say non-monetary asset, actually non-monetary means where fixed cash is not determinable. Repeat. Non-monetary means where fixed cash is not determinable. Now, what do you mean by this? Let me explain. Try to understand the meaning of monetary asset. That will help you to understand non-monetary asset. Actually, when we say monetary asset, monetary means where fixed cash is determinable. Let me give you the example of monetary. The monetary asset example is accounts receivable. Can I say in case of accounts receivable, you exactly know that how much cash you are going to get. Accounts receivable. And there's no need to think for the bad debts. I'm not talking about this. There's a guarantee you will get the same amount. I'm saying in case of accounts receivable, at least you know that how much you are going to get. So that is monetary asset. So monetary means cash is itself a monetary asset. So monetary means where cash is determinable. So the example of monetary asset, I've given you the debtors, your accounts receivable. If I give you an example of a monetary liability, Accounts payable is a monetary liability. Bank loan is a monetary liability because we know how much cash we have to pay. Here we are saying an intangible asset is an identifiable non-monetary asset. Means fixed cash is not determinable. Without a physical substance. It does not have a physical substance. But it has to be identifiable. An identifiable asset is initially recognized at cost. If it is identifiable, it is controlled by the entity. This is very important. Controlled by the entity. Can I say if Microsoft has developed a new software? So obviously that new software is identifiable because it is separately saleable from other assets. When we say identifiable, so it means you can in case of selling, you can sell it separately from other assets. It is identifiable and it is controlled by the entity. Let's say Microsoft has developed a new software. So obviously they have to, nobody else is going to prepare the same software and sell it. Microsoft has the control. It will generate probable future economic benefit for the entity. Probable future means more than 50% chances company will get the economic benefit. And it is not necessary that you will be getting the economic benefit always by selling the asset. You can also get the economic benefit by using the asset. For example, let's say there's an XYZ company, they have made a software and they've just made for themselves. They're using that software. By using that software, they are saving the cost. So when we say future economic benefit, it could be by selling that asset or it could be by using that asset. The cost can be measured reliably. So an intangible asset is initially recognized at cost. If it is identifiable, controlled by an entity, it will generate probable future economic benefit and the cost can be measured reliably. If an intangible asset does not meet recognition criteria, then obviously you have to expense out. Then it should be charged to the statement of P&L as expenditure incurred. Intangible assets should be amortized over their useful life. If your intangible asset is having a specific life, then it will be amortized over their useful life. If it cannot be demonstrated, then useful life is indefinite. Then no amortization should be charged, but an annual impairment review must be carried out. If it can be demonstrated that useful life is indefinite. Let's say right now we cannot estimate the useful life. The life is so big. In that case, no amortization, but you have to carry out the impairment loss annually, irrespective of any indicator of impairment loss. Now the question is how it is possible that intangible asset is having an indefinite life. Let me give you an example. The example, I hope everyone has heard about Levi's. Levi's is a really big brand of clothes from USA. Now, today we are in 2025. Okay, Alhamdulillah. If today just let's say if someone asks you a question that what do you think? How many more years the brand Levi's will be there? So obviously we'll say many years. Right now, we cannot count the life. Right now, we say it will be there for many years. How many, we don't know. Because nobody knows that after 10 or 15 or 20 years, XYZ brand comes and let's say, we cannot say anything. But right now, simply, we cannot estimate the useful life of Levi's. Right now, we can say only one thing that Levi's will be there for many, many years. So if you have an intangible asset which has indefinite life, then no amortization, but you have to carry out the impairment review every year. Intangible asset can be revalued, but only, this is important, okay, but only if fair values can be determined with reference to the active market. Now try to understand. IS 38 says initially intangible asset will be at cost. Subsequently, you have two models. One is cost, another is revaluation model. Revaluation model is only available when there is an active market of your intangible asset. Now try to understand. According to IAS 38, majority of the intangible assets of the company, they do not have the active market. That is why the more suitable model for them is cost model rather than the revaluation model. Costs incurred during the research must be expensed as they are incurred. Costs incurred during the development should be recognized as an asset if they meet the following criteria. Student, number one, you should understand this criteria, plus you should memorize the criteria. So costs incurred during the research must be expensed as they are incurred. Costs incurred during the development should be recognized as an asset if they meet the following criteria. Number one is the project is technically feasible. Let's say 30 or 40% work has been completed, still 60% is left. Let's say the completion is technically feasible. Assuming the skill level which you need to complete that intangible asset is still there in your organization. So the completion is technically feasible. The asset will be completed, then used or sold. Of course, once the asset is completed, either your company is going to use it or sell it. The entity is able to use it or sell the asset. An entity is able to use or sell the asset. The asset will generate future economic benefit. The entity has adequate technical, financial, and other resources to complete the project. So simply as we were saying that you have completion of the project is technically feasible, financially feasible, other resources to complete the project. The expenditure on the project can be reliably measured. Amortization over the useful life of the new product or process will commence once the project is complete. And always remember one point. Under IAS 38, once you have expense out the cost, you cannot capitalize it. Until unless your company proves that it was an error by mistake. We have treated development expenditure as research. If you can prove that it was an error, it was a mistake, then by using IAS 8, change in accounting policy and errors, by using IAS 8, then you will do the correction of error, and then you can capitalize the borrowing cost. Then you can capitalize the cost which you have expensed out under IAS 38. But you have to prove that it was a mistake. By mistake, we have expensed out the expenditure which we should have capitalized. Now, correction can be made by using IAS 8. So students, I just want to stay the class number 2. Let's keep the class still here. In the next class, inshallah, I'll be discussing the duration of the next class will be a little bit longer than the second class. And then, as I mentioned already, from class number 4 onwards, we will start the discussion of the past paper and the duration of the class will increase. It will still remain once a week, but duration will increase. Inshallah, you will see that. Is there anything, student, you want to ask? We have last minute before I end the class. Anything you want to ask, you want to say, please go ahead. Anything, students? Before I end the today's class. I think today we started the class at 2:30. Timings will remain same. Either it will be 2 p.m. or 2:30. Day and timings will not change. Only the duration will increase. So everyone knows in advance that they have to take out the time for the live revision class. Okay, students. So thank you very much for attending today's class. See you all inshallah in the next class as well. Thank you.